There is a number that most people never hear about. Not because it is classified, not because it is buried in some archive that only governments can access. It sits in plain sight, inside mineral surveys, geological reports, and trade analyses that have been published for decades. The number is $83 trillion. That is one estimate of the total mineral wealth sitting beneath the soil of the Democratic Republic of Congo. 83 trillion. That is larger than the combined GDP of the United States and Europe. That is not a figure from a political pamphlet. That is a figure that mining companies, investment banks, and foreign governments have used to orient their entire Africa strategies for over a century. And yet, when you look at where the Congolese people stand today, the picture is almost impossible to reconcile with that number. More than 70% of the population lives on less than $2.20 per day. Infrastructure is fractured. The national health system is chronically underfunded. Basic electricity access in rural provinces remains unreliable or entirely absent. Schools that should be built on resource revenue sit unfinished. A country can hold the largest proven reserves of cobalt on the planet, produce a mineral that powers the batteries inside every electric vehicle being sold in California, Germany, South Korea, and Japan, and still watch its children grow up without clean water in their villages. This is not a coincidence. This is not bad luck. And this is not simply the result of conflict or corruption in isolation. What we are going to examine today is the architecture. The deliberate, layered, historically constructed architecture of how wealth is extracted from a country before its own people ever see a cent of it. And we are going to look at what it would take, what it would actually require structurally and politically to change that architecture for good. Because the story of Congo is not just a tragedy. It is a blueprint that has been used across the African continent, across the Caribbean, across every territory that sits on natural wealth and was told, generation after generation, that its poverty is its own fault. Let us start at the ground level, literally. Congo holds an estimated 50% of the world's cobalt reserves. It produces roughly 70% of the global cobalt supply. Cobalt is not an obscure metal, but it is the material that makes lithium-ion batteries stable. Without cobalt, the electric vehicle revolution does not function. The laptops, the smartphones, the energy storage systems driving the so-called green economy of the 21st century all depend on this element. And the element comes, in overwhelming proportion, from one country. Beyond cobalt, Congo holds enormous deposits of coltan, the ore that contains tantalum, which is used in virtually every capacitor inside electronic devices globally. It holds copper, tin, tungsten, diamonds, and gold. The eastern provinces alone have been described by geologists as a geological scandal, meaning the concentration of mineral wealth in one relatively small territory is almost absurdly high. Now here is where the architecture begins. Congo does not process most of what it mines. Raw ore leaves the country. It is refined elsewhere, in China, in Europe, in North America. The value added through processing, manufacturing, and technology development happens outside Congo's borders. The country receives the price of the raw material. Everyone else captures the margin that comes from turning that raw material into a finished product. This is not accidental. The structure of colonial-era trade was explicitly designed to prevent industrial development in resource-rich territories. Raw materials out, manufactured goods in. That structure did not dissolve when independence was declared. It was embedded into contracts, into infrastructure design, into the very shape of the transport networks built during the colonial period. Railroads and roads were built to move minerals to ports, not to connect communities or build internal markets. The contracts governing mining operations in Congo have historically been written in ways that prioritize the investor's return above the host nation's revenue. Stabilization clauses, a legal mechanism that appeared across resource contracts in Africa and Latin America throughout the latter half of the 20th century, allowed mining companies to freeze their tax obligations at the rate agreed at the time of signing, even if the host government later revised its tax laws. In practice, this meant that as Congo's mining laws evolved, as governments attempted to capture more revenue from the boom in global mineral prices, companies could argue that the new rules did not apply to them. Transfer pricing is another mechanism that operates almost invisibly. So a mining subsidiary in Congo sells ore to a related trading company registered in a low-tax jurisdiction, often at below-market prices. The profit is declared in the tax haven, not in Congo. The country where the minerals actually came out of the ground books a smaller revenue figure than it should, and the parent company moves wealth through the structure legally without triggering the scrutiny that traditional tax evasion would attract. This is not speculation. Multiple audits of Congolese mining revenues conducted by regional institutions and independent researchers have found persistent gaps between what the country should theoretically receive based on production volumes and global commodity prices and what actually lands in government accounts. The gap does not simply evaporate, it accumulates somewhere else. There is another layer to this that rarely gets discussed in mainstream coverage of Congo, and it connects directly to a broader conversation about economic sovereignty that figures like Ibrahim Traoré have brought back into focus across Francophone Africa. Debt. Congo carries a substantial external debt burden. As of recent years, the country owes billions to multilateral creditors, bilateral lenders, and commercial debt holders. Debt service, meaning the regular payments of interest and principal on borrowed money, consumes a portion of government revenue that could otherwise be directed toward health, education, or infrastructure. When a government is paying creditors before it is investing in its own citizens, the political economy of the country is structurally oriented outward, not inward. Here is the mechanism that tightens the grip further. When Congo needs to refinance debt or seek emergency financing, the conditions attached by institutions like the International Monetary Fund often include requirements around fiscal austerity, privatization of state assets, and liberalization of sectors like mining and finance. These are conditions that, in structural terms, tend to expand the operating space for foreign capital and restrict the government's ability to impose new terms on extractive industries. So the country is simultaneously losing revenue at the mine, losing revenue through the financial architecture of the contracts, servicing debt that was often accumulated under previous governments and under circumstances that did not benefit ordinary citizens, and being advised by international creditors to keep the environment attractive to the very investors whose contracts are the source of the revenue gap. It is a loop, and it was not designed accidentally. Now let us pause here for a moment, because this is the point where some analysts shift the entire conversation toward internal governance, toward corruption among Congolese officials, toward the failures of the state itself. And it would be dishonest to pretend that internal governance challenges are not real. They are real. But framing the Congo story primarily as a governance failure does something very specific. It removes the structural factors from view. It makes the poverty look like a product of Congolese choices rather than a product of a system that has consistently operated against Congolese interests, teams often with the active participation of external actors. History is clear on this point, even when it is uncomfortable to state plainly. The assassination of Patrice Lumumba in 1961, just months after Congo's independence, was not a domestic political event in isolation. It was an operation that involved intelligence agencies from Western governments who were deeply concerned about what a sovereign Congo, one that intended to use its mineral wealth for the benefit of its own people, would mean for their access to those resources. Lumumba's government was moving towards state control of the mining sector. That was the source of the threat. What followed, the decades of the Mobutu era, supported politically and economically by Western governments precisely because Mobutu kept the country open to foreign capital, produced a model of governance that was catastrophic for ordinary Congolese citizens. The wealth flowed outward. The debt accumulated. The institutions that would have allowed the country to process its own minerals and build an industrial base were never built. That history is not just history. It is infrastructure. It shapes who holds contracts today, which legal frameworks are in place, which external actors have standing to influence government decisions, and which Congolese institutions are strong enough to push back. When Ibrahim Traoré stood up in Burkina Faso and began talking about renegotiating mining contracts, about auditing what the country had actually received versus what it had given away, about returning the ownership logic of the country's resources to the state and by extension to the people. He was not speaking about Burkina Faso alone. He was articulating a position that is directly applicable to every resource-rich country on the continent that has spent decades inside the same extractive architecture. The concept of economic sovereignty, the actual operational principle that a country's resources should generate primary benefit for its own citizens before external investors, is not radical. It is the foundational logic of how wealthy nations have always managed their own resource sectors. Norway built one of the world's largest sovereign wealth funds off its petroleum revenues precisely because it insisted on state participation, transparent revenue accounting, and domestic reinvestment requirements. Canada imposes stringent environmental and royalty terms on mining companies operating in its provinces. Australia reviews foreign investment in its mining sector through a national interest lens. These mechanisms are not socialism. They are the ordinary instruments of economic governance that every wealthy nation uses without apology. The difference is that when an African nation attempts to apply those same instruments, it faces a specific set of pressures. Bond markets reprice the country's debt risk upward, increasing borrowing costs. International business media runs assessments of declining investor confidence. Diplomatic pressure arrives through bilateral channels. In some historical cases, the pressure has gone well beyond diplomacy. That asymmetry is not a conspiracy theory. It is the documented pattern of how economic power operates when its interests are threatened by a country deciding to govern its own resources on its own terms. What would it actually look like if Congo began to move in a different direction? Not in the sense of a dramatic overnight transformation, but structurally, at the level of the contracts, the revenue architecture, and the reinvestment mechanisms. The first place to look is the mining code. Congo did revise its mining code in 2018, and the revision was significant. It increased royalty rates on strategic minerals, including cobalt, raised taxes on profits in certain categories, reduced the duration of automatic contract renewals, and strengthened requirements around domestic hiring and local procurement. The revision was contested aggressively by mining companies, and several of which invoked stabilization clauses to argue that the new rates did not apply to them. The gap between what the code says and what the contracts actually deliver is the space where economic sovereignty either lives or disappears. Closing that gap requires enforcement capacity, independent auditing institutions, legal systems that are resourced enough to challenge international arbitration, and a political environment in which officials who renegotiate contracts are protected rather than pressured. None of those things appear automatically. They have to be built deliberately, and they have to be built against resistance from actors who benefit from the current arrangement. The second area is processing. The argument for building refining capacity inside Congo is not ideological. It is economic. What if Congo could process even a portion of its cobalt into battery-grade material before export? The price received per unit would be substantially higher. The value added would be captured domestically. Jobs in processing and manufacturing would be created. The country would participate in a more sophisticated position in the global supply chain. China understood this logic when it invested in processing infrastructure across Africa. Chinese companies secured rights to Congolese cobalt ore, partly in exchange for infrastructure and investment commitments. The strategic rationale was clear. Secure the raw input and control the processing chain. Congo can apply the same logic in reverse, but only if it has the political and institutional capacity to impose domestic processing requirements as a condition of mining licenses. The third area is revenue transparency. Some of the most important progress in the broader global conversation about extractive industry governance has come from transparency frameworks that require mining companies to disclose what they pay to governments in each country where they operate. When those payments are publicly disclosed, civil society organizations, journalists, and opposition politicians can compare the disclosed amounts against production volumes and commodity prices and ask pointed questions about gaps. Congo has participated in transparency initiatives before, but participation alone does not change the underlying contracts. Transparency is a tool, not a policy. The policy decision that matters is what the government does with the information that transparency reveals. Here is something worth understanding about where the global conversation has moved. The demand for cobalt and other critical minerals is going to increase sharply over the next several decades, not decrease. Every major economy in the world has committed to electrification targets that are entirely dependent on mineral supply chains that run directly through Congo. The global north needs Congo's ground. It needs it urgently. That is leverage. That is a fundamentally different negotiating position than the one Congo has historically occupied. The question of economic sovereignty is not abstract when the world's largest economies are competing for access to your soil. Whether that leverage translates into actual benefit for Congolese people depends entirely on the political and institutional architecture inside the country. It depends on whether contracts are negotiated by officials who represent the national interest, whether revenues are managed through accountable systems, whether reinvestment requirements are enforced, and whether the international environment allows Congo the space to govern its own resources without being punished economically for trying. Ibrahim Traoré's significance in this regional conversation is not as a solution to Congo's specific situation. It is as a demonstration that the conversation itself can be had openly. That a leader on the African continent can stand up and say plainly that we have been giving more than we have been getting, and that this is going to change, without automatically retreating from that position under the first wave of external pressure. The content of that position, the actual policy mechanisms of auditing contracts, building processing capacity, insisting on transparent revenue accounting, creating sovereign wealth structures that hold extracted value inside the country, rather than letting it flow directly into external accounts. Those mechanisms are transferable. They do not belong to one country. They belong to the logic of economic sovereignty itself. Congo's situation has one additional dimension that makes the governance challenge extraordinarily difficult. and it would be incomplete not to acknowledge it. The eastern part of the country has been in persistent conflict for decades, and the mineral wealth of that region is directly connected to the conflict economy. Armed groups have historically controlled mining sites and taxed the movement of minerals. Supply chains have moved ore through informal channels that bypass formal revenue collection entirely. The intersection of militarized extraction and state weakness has created conditions where rebuilding control over the resource sector requires stabilizing a security environment that itself is partly driven by competition over that same resource sector. This is a reinforcing cycle, and it is one that external actors have at various points worsened rather than improved, either through continued demand for minerals regardless of supply chain provenance, or through interventions that destabilized rather than consolidated the state. There are no simple answers in the Eastern Congo context, but the starting point for any honest analysis is the same starting point that applies to the contract architecture and the revenue flows. Who benefits from the current arrangement, and does that group have an interest in it remaining unchanged? When you ask that question honestly, the picture clarifies. The beneficiaries of Congo's current extraction architecture are not primarily Congolese. They are the shareholders of multinational mining companies, the institutional investors who hold those shares, the trading firms that move the ore, the downstream manufacturers who process it, the consumers who buy the finished products, and the financial systems that service the debt structures that keep the Congolese state in a position of dependency. The Congolese people are at the end of that chain, not the beginning. Changing that requires more than moral clarity, although moral clarity is the starting point. It requires building the institutional machinery, the legal frameworks, the enforcement capacity, and the political will to redirect the flow. It requires an international environment in which resource-rich African nations are not systematically penalized for exercising the same sovereign rights over their economies that wealthy nations exercise without question. And it requires an audience, meaning people who understand the architecture well enough to recognize what economic sovereignty actually looks like when it is being practiced, and to refuse the narrative that poverty in resource-rich nations is a natural condition rather than a constructed one. The ground beneath Congo is not the problem. The ground is the inheritance of every Congolese citizen. The problem is the system built above that ground, the one that routes the value of what comes out of it away from the people it belongs to, and has been doing so for over a century. That system has a structure. It has a logic. It has beneficiaries who understand it precisely, and it will not change until enough people understand it just as clearly. This is what the ledger actually shows, when you open it all the way. The entry is not poverty. The entry is extraction. The outcome is not inevitable. The outcome is managed, and managed things can be changed. That is where the real conversation begins.